So today we are actually going to discuss the pre-September 2026 mock of SBR. And the purpose of this session is not going to be to draft an answer, rather to read the requirements, read the exhibits, and to plan the answer. Because when it comes to the answering part that we do in the live classes, therefore you would be required to join the live classes to break down how the answers are structured in a time constraint manner, not a perfect answer, but an answer that a candidate can write, okay, under time pressure environment. Because in those classes, I will be getting into the shoes of the candidates and I will be drafting the answer under time pressure, time constraint, and to give an experience to the students as to how to collect marks, not with a perfect answer, but a complete answer. All right. So the purpose of this session is to analyze and to understand and to plan your answer. All right. Okay. So moving on to the first question. So let's start off with the first question. So this question, whenever you think about answering a question, first thing that should come to your mind is the time. All right. And we know first question is 30 marks. Now you should translate it into the available time for you. All right. So if we take 3 hours and 15 minutes paper, you break that down into 100 marks. You have 195 minutes in total, therefore 1.95 minutes per mark. But if you leave that 15 minutes for reading time, and for safe side, that is the ideal approach that I recommend to my students, is to use 3 hours to plan your answer. So you have 180 minutes. So 180 minutes divided by 100 marks would give you 1.8 minutes per mark. Okay, therefore a 30 mark question would translate to 1.8 equals 54 minutes. So you know you need to spend 54 minutes in this question. So that's the first thing that you do. First exercise, you quickly note down the available time and spend that exact time on this question. As the time's up, move on. All right. Okay, so Morstone operates in the agri-food industry and owns shares in a number of companies. So what I always suggest you all to do is first read the background, then read the requirements, and then you read the exhibit that's relevant to the requirement. Because you read the background, you read the exhibit, then you go to the requirement, you don't know what the requirement is, you don't know what to look at in the exhibit, and you would not even remember the information that's in the exhibit until you get to the requirement. Therefore, first you read the background, then you read the requirement, and then you fulfill each requirement by looking at those specific exhibits and you answer accordingly. And as you complete each of the requirement, I also suggest my students to go and complete the pre-populated spreadsheet. Otherwise, if you leave that for absolute n, you will have to come back into your answers and you'll have to hunt for the numbers or the figures. Therefore, as you've calculated the figures, as you've completed a requirement, quickly go and park it under the spreadsheet as well, right? So that's a multitasking you'll be doing. So you are recommended to attempt these past papers or these pre-mock papers on the practice platform because that gives you an actual or a hands-on experience of how the exam would or the actual exam would be like. All right. Okay. So let's read the background first. Morstone Co is a company. So when you're applying, you have to use this term or use this name. Uh, Operates in the agri-food industry and owns shares in number of companies. So there are going to be multiple subsidiaries in this case, and there can be associates also. The group's current financial year end is 30th June 2021. This is very important. The first thing that you read and understand is the year end and the time period this question covers. All right. Then there are 5 exhibits. First one, focusing on foreign currency transactions, provides information about 2 transactions denominated in the HIM dollar. Right. Now you have to figure out what the functional currency is, what the presentation currency is, where the translation works. Then the second exhibit is focusing on forward contract hedging from IFRS 9, right? So this is IAS 21. Yeah. Forward contract is IFRS 9 Provides detail of a hedge against a future purchase of an item of plant in a foreign currency. So IFRS 9 and IAS 21 overlap, right? There is foreign currency risk that is being managed in this case. Yeah. Then the third exhibit, the acquisition of Swinstico, explains the acquisition of Swinstico on 1st January 20XO, right? 1st January 20XO. The year end is 30th June 20X1. So Swinstico is going to be there for the period Jan to June. So that's 6 months, right? 6 months. And standards that apply here is IFRS 3, IFRS 10. All right. And in case it's an associate, IAS 28 applies. All right. Further information is given in Exhibit 4, provides further information about the draft consolidated statement of profit or loss and other comprehensive income. Okay, now we know that it's going to be draft consolidated statement of profit or loss and other comprehensive income that you are supposed to work with. Okay, then this timing becomes very important. Where consolidation, if at all, is done based on the proportionate timing. All right. Then the fifth exhibits draft consolidated SOPL and OCI. All right. Okay, so here IFRS 18 is applicable because that's applicable throughout, right? For all the calculations, presentations, recognition. Now, this entire paper is having about 19 standards. Yeah. So 19 standards covered within 100 marks. So those who speculate, those who try to understand the patterns and figure out what would be the questions, try to, forecast, don't do that, right? Because there are going to be multiple variants of paper in each sitting, and each variant can cover any area of the syllabus. So be prepared with 100% of the syllabus, breadth over depth. Don't be over prepared in a single area, right? You don't need to be deeply knowledgeable in limited area. Rather, you need to be broadly knowledgeable in all areas. Okay, 100%. Right, now let's go into the requirement. Right. Now, requirement number A, right? So, first requirement is A. Question A asks you specifically to use Exhibit 1. So, don't go to use Exhibit 2, don't use Exhibit 3, don't use Exhibit 4. You're supposed to use Exhibit 1 in order to respond to this question. Then you understand, okay, what are the sub requirements and what are the verbs? All right. Okay, sub requirement 1 wants you to calculate the exchange differences to be included in consolidated financial statements for the year ended 30th June 20X1, explaining how each should be presented. Explaining the presentation. So what are you supposed to do here? Calculation, right? And then explanation of presentation. All right. You don't need to explain the entire thing, rather the presentation. Okay. So when there is exchange differences in terms of a consolidated financial statements or group accounting, you need to understand that there will be OCI component that will play an important role, because any exchange gains or losses arising as a result of the foreign operations will be parked under OCI, which will be reclassified to profit or loss later on, right? That should be the concept that you should be recalling. Even before I went into exhibit, I have tried to plan, structure the answer, try to think through, okay, if this is being spoken about, what is the relevant knowledge I should have or I should recall? All right, that's what I'm doing. So we are planning the answer. Okay, calculation, you have to calculate, provide calculation. So calculation requires you to provide workings as well, because workings also gets you marks, and there's own figure rule that you need to remember, right? And explanation, you need to explain the presentation, right? So presentation, you have to speak specifically from P&L and OCI perspective, because that's the draft that's given. So you have to focus your answers to whatever the financial statements they are providing you. Okay. Right. So in this case, you also should remember there is going to be apportionment between parent and NCI. Okay. The profit or loss and OCI apportionment between parent and NCI also will be there, since it's SPL and OCI. All right. Then second sub requirement asks you to discuss how the exchange differences calculated are recognized. How discuss, meaning you have to now talk about it in depth, right? A balanced argument needs to be brought in, and you have to take a stand, right? Take a position. Yeah, discuss how the exchange differences calculated are recognized, referring to the requirements, right? Now you have to speak from the requirements of conceptual framework, right? Conceptual framework. So when it is talking about recognition, it mainly wants you to talk about SPL related gains and losses and OCI related gains and losses, right? The IFRS 18 says exchange differences would be following the relevant category of the underlying item or underlying asset or underlying liability. All right. The purpose of underlying item, rather. Okay. So SPL related gain or loss, how that's recognized, OC related gain or loss, how that's recognized, and how the conceptual framework requirements are playing an important role. So you have to talk about mainly from the perspective of when there are two sections where same exchange difference is shown, how that's affecting the conceptual framework related qualitative characteristic. Okay, right. So that's requirement A. So we've planned the answer. Now, when we go into the exhibit, we have a better idea as to how to respond to that question. All right. Now let's go and read the exhibit before we go read the requirement 2 or B. Let's go and read the exhibit. Right. During the year ended 30th June 2021, Morstone Co. entered into two transactions denominated in the Hem dollar, the currency of Hemland. Right. Morstone entered into two transactions denominated in Hem dollar, the currency of Hemland. All right. And what is the presentation currency? So any subsidiary related functional currency needs to be translated to presentation currency, right? So presentation currency, since dollar is being shown here, so dollar should be the presentation currency, right? But as we read, it will be mentioned somewhere, right? On 1st July 20XO, meaning beginning of the year, the company acquired a 90% equity shareholding in Ella Ball Co., a supplier. 90% equity shareholding in Ella Ball Co., meaning control, meaning subsidiary, meaning consolidation. Now you have to look at whether it's a full year, a mid-year, or end of the year acquisition. So you see it's 1st of July 20XO, year end is 30th June 20X1, so it's a full year acquisition. So any consolidation adjustment would be based on 12 months, right? Full year. All right. So it's a full year. Right. Giving rise to a goodwill of HD 6.1 million. Now that's a goodwill. For the purpose of calculating goodwill, the non-controlling interest was measured as a proportion of net assets, right? Proportion of net assets for the purpose of calculating goodwill. Now, as we went into the question, we did discuss there's going to be apportionment between parent and NCI, right? But when the NCI was measured as a proportion of net assets, any impact, foreign exchange difference impact or impairment impact happening would be relevant to the parent only, right? So any exchange gains or losses arising due to goodwill retranslation would be relevant to the parent, 100% to the parent. There is no allocation to NCI in that case. Okay. Everything else, there is an allocation to NCI. All right. Okay. The net assets of Ellaball Co. had a carrying amount equal to the fair value of HD 49.9 million. There's no fair value adjustment at the acquisition date. A carrying amount of HD 6.3 at 30th June 20X1, right? 56.3 was the carrying amount and 49.9 was the fair value. So there is, if you look at the difference, that's going to be the post acquisition. Right. So we have goodwill here. We have net assets. So IAS 21, foreign operations, right? What are the mechanics? Now you need to know the mechanics of translation, all right? So when it comes to foreign operations, let me open another page here, right? So when we talk about foreign operations, right, meaning IAS 21 in relevance to group accounting, okay? So in this case, what would happen? you need to remember that all the assets, liabilities would be, and any equity item that is to be shown separately, because you take shareholders shareholding, right? The share capital, the share premium, you don't recognize, right? There's no post-acquisition recognition. Rather, you only show the parents one. So whatever the subsidiaries part is also used, in that case, you would be retranslating these at the year end, right? Year end retranslation is necessary using closing rate. Now, this is SFP, Statement of Financial Position item. Then SPL items will be translated at average rate. So there are two rates that are applicable here. There's closing rate retranslation, there's average rate translation. So if you talk about the profit or loss of the subsidiary throughout the period, would be translated at average rate. All right. Okay. So that's the mechanics of foreign operations translation. Now we know that in this case, both goodwill being an asset, arise as a result of foreign operations, and net assets being the net assets of the subsidiary, right? Whatever requires to be shown, yeah, will be retranslated. All right, will be retranslated. So in this question situation, you have your goodwill. Take your goodwill. So you're supposed to calculate first, right? Goodwill at acquisition, right? Translated using acquisition date rate, meaning spot rate on the acquisition date. Okay. And then if there is impairment, I'm highlighting if, right? In this question, there is no impairment. You have to translate that at average rate, because that's a statement of profit or loss item, right? And then you have to retranslate goodwill at reporting date. That's going to be the closing rate, meaning the spot rate on the closing date, on the reporting date, right? So when you do this, right, when you have goodwill at acquisition, translate acquisition rate, then you have goodwill at reporting translated using closing rate, there is going to be an exchange difference. Exchange difference. Okay, now that will be parked under OCI allocation 100% to the parent. Okay, 100% to the parent. Then there is net assets. That's situation number one here. Then there is net assets. Okay, net assets. So net assets, again, you have net assets at acquisition translated at acquisition date rate, right? Then you have the post acquisition retained earnings, right? Post acquisition retained earnings, meaning profit. You have to use the average rate. Then you have net assets at closing date, right? Net assets at reporting date. Reporting date, you have to retranslate at closing rate. Now, since these are balance sheet items or statement of financial position item. All right. Okay, so as I always suggest you all, use a 3-column structure. Yeah. So you have the functional currency, which is the hem dollar. Then you have the exchange rate. Then you have the translated at presentation currency, which is dollar. Okay. So if you take net assets at acquisition, in functional currency, what's the value? right? So let's go into the exhibit and try to get the value for that. Net assets we know is 49.9 million, right? So you go here, you put 49.9 million, right? Then you have net assets at reporting date. So you put in HEM dollars in one column, then you put the exchange rates in the second column, then you arrive at the presentation currency value. Okay, so that's how you calculate. So you're supposed to calculate the goodwill, you're supposed to calculate net assets. So there is going to be exchange gains or losses, right? Now, because of this also there, this is also a foreign operations translation. So exchange gain or loss will be recognized through OCI. Now, this is going to be allocated to both parent and NCI, right? Based on whatever their shareholding is. Okay. So what did I say? We are planning the answer. Still, we are planning the answer, right? But this is an extended planning that I'm giving you. Whatever we are doing right now will form your answer. All right. So when we are writing an answer, we are drafting the answer. We would be drafting alongside planning. Okay. Right. So here I'm just giving you all the idea and the knowledge that you'll have to be able to recall. Right. That's the first transaction. Then you have the second transaction. On 12 June, Morstone co-purchase, right? 12 June 20x1. 12 June, right, closer to year end. Morstone Co purchased goods for resale on 60 days credit from El Campo Co, an unrelated company. So it's not related. At a cost of HEM $430,000. At the year end, the amount has not been paid, right? Now, for this purpose, you will have to remember IAS 21 non-group mechanics, right? Non-group mechanism of translation, right? So what does the non-group mechanism talk about? If we talk about IAS 21, there is going to be monetary versus non-monetary assets, where monetary asset could either be settled or unsettled, right? So now this will have to be, now there are three main rates here, right? Transaction date rate, so that's a spot rate. Then there is average rate. Then there is closing rate, right? Now, monetary items need to be translated on the transaction date at the transaction rate, right? So on 12 June, X1, you have to take the 430,000 HEM dollar and translate at the transaction date rate, okay? And then when you read it further, they are saying, right, the amount has not been paid, meaning it's unsettled, right? So what happens when the transaction is happening? There is a payable, right? A payable is a monetary assets, unsettled, and this will need to be retranslated at closing rate, right? Whatever, now HD 430, we did translate at transaction date rate, right? Then we will be retranslating the entire amount, since entire amount remains unpaid, at closing rate, right? Closing rate. Now, in case, let's say there was partial payment that happened in the middle, so that partial payment will have to be translated at the spot rate on the settlement date, the payment date, right? So there are going to be multiple layers there. But in this case, entirely unsettled. So first you recognize it at the spot rate on the transaction date. Second, you are going to retranslate the unsettled monetary assets, which is payable, on the closing rate. And this would, because there is a difference between this, it will give rise to exchange differences. Right? Now, this exchange difference will be recognized in statement of profit or loss, not OCI, rather profit or loss. Why? Because they have purchased from an unrelated company for a normal operating purpose, right? It's an operational purpose. It's going to be recorded in statement of profit or loss, because IFRS 18 says whatever the purpose of the underlying item is, it will be recognized under that category. Operating category, operational requirement is the purpose. That's an operational decision, and that's why this will be recognized under operating section. Okay. Now, whatever we recognize in OCI will be recycled at disposal. Okay. So those are the two transactions. Yeah. So what was the requirement? Requirement wanted you to calculate. So we did understand how the calculation works using different rates, which would give rise to exchange differences, right? Then explain how each should be presented. So we did discuss OCI, then P&L, right? So whatever we discussed, that's how you're going to write down, right? Why OCI? Because it is going to be a foreign operations translation. And the first one not allocated to NCI because 100% since NCI is at net assets method. Second one allocated to both parent and NCI, OCI. Third situation is where P&L is where it goes, not OCI, and that is going to be allocated across both the parent and NCI, and that's going to sit in the operating section of P&L. You have to be very specific when you are explaining the presentation. So you're showing where does it go and sit. Okay, so that is your requirement A. Then your requirement B. Oh, requirement A2. So A1 we are done with. Now A2, discuss how the exchange differences calculated are recognized. So we know SPL is where it's recognized, OCI. Then we have to refer to the requirements of the conceptual framework, right? So how do you think about answering this question, right? A2. You have to speak about from the perspective of SPL versus OCI, right? Exchange differences, although it's the same quality, right? Exchange difference, right? Ideally, it should be the same situation. But why is it being recorded under two different areas? Now that raises question on comparability, right? Comparability. Yeah. You can't compare if these are sitting in different places, right? But there is one more requirement of relevance and faithful representation. So when you show whatever is operational related exchange difference, that you showing in SPL makes sense because it actually shows the performance of the organization, right? It talks about the performance. But when you talk about the foreign operations retranslation, it is now both are unrealized, right? But the foreign operations retranslation that you are doing, foreign operations still sitting with you, right? Only once you are disposing it, you're going to realize whatever you have achieved. So if you show it prematurely under P&L, the P&L will be distorted, right? P&L will provide a wrong image. Therefore, conceptual framework requires you to show all the income and expenses in P&L unless it is going to distort the P&L. If it's going to distort the P&L, it will be recorded under OCI. OCI is considered to be a place where low quality gain or loss is going to be recorded, which would, if recorded under P&L, would be showing a distorted picture. Okay, you speak from comparability perspective, speak from relevance perspective. You do discuss how there are two different situations, and then you talk about how conceptual framework requires you to record income and expense through SPL unless distorts, right? SPL, and to avoid distortion, you have to recognize through OCI, which is considered to be a place where every low quality gain or loss will sit, right? Until realized on a future date, right? Recycled at disposal, right? You speak from this context, okay? So you don't need to speak about non-recyclable, which you would not be bringing to SPL. Rather, you speak about from the context of the exhibit, right? So you can bring knowledge. Now, as you saw, now why did I bring certain knowledge? Was for your information purpose, but you can't bring those knowledge in your actual exam. All right. I did speak about the mid part, right, where I spoke about the settlement, right? But you're not supposed to speak about that. There's no settlement happening, right? Whatever I brought in now, this entire thing, monetary, non-monetary part, settled part, don't speak about it. Speak about only monetary and unsettled. Okay. To speak about this, it's irrelevant knowledge that you're bringing. All right. And then as we go up, we did look at impairment, right? So I brought it in to show you, right, for knowledge purpose. But when you go into the exam, do not talk about it. It's irrelevant knowledge. You're bringing in irrelevant knowledge. So bring only the knowledge that is relevant and that can be applied. Okay, right. So that is requirement A from Exhibit 1. Right, so rates of exchange between the dollar and HT have been given. First July rate is there, which is the acquisition or opening rate, 12 June transaction rate, 30th June closing rate. Average for the year, and they've given average rate also. Neither Morstone Co. nor Elaboral has recognized any amount in respect of exchange gains or losses in their individual financial statements. Elaboral Co. has otherwise translated its financial statement in accordance with IFRS accounting standards. Right, okay. Now we can move into requirement B. What is requirement B? Using exhibit 2. Now you have to use exhibit 2. Okay. Now don't go and look at exhibit 1. You already looked at it. Now you limit your answer within the exhibit 2. Then there are two sub requirements here. Sub requirement 1, discuss whether. Now discuss. Take a standpoint. Right? Whether Menwith Co. is correct to apply hedge accounting. Whether Menwith Co. is correct to apply hedge accounting. You have to take a stand whether they are correct or not correct. If they are correct, discuss and show through a discussion that they are correct. If not correct, show through a discussion that they're not correct. So balance argument and take a position. Okay, right. Then requirement 2 of exhibit B, sub requirement 2 of requirement B is explain how Menwith Co. should account for the hedging arrangement in the year ended 30th June 2021. So to explain how the accounting is done, calculating amounts to be recognized in financial statements. So here you're supposed to, now first one is supposed to discussion. Now here you're supposed to explain accounting alongside calculation, meaning it should be supported by calculation. That's what they want you to do. But what are you supposed to limit your answer within? Exhibit 2. Right. Let's go and read. Forward contract. On 12th May 2021, Menwith Co., which has been a 75% owned domestic subsidiary of Morstone Co. for over 10 years, signed a contract. So on 12th of May was the signing date. Signed a contract to purchase a major new item of processing plant. Right, signed a contract to purchase a major new item of processing plant. The plant will be purchased from a supplier based in Whitland, a foreign supplier where the local currency is Whitmark. Right, purchasing from foreign supplier, meaning there is going to, when we read until this point, we understand, okay, Menwith Co. is having a risk, currency fluctuation risk that is there, right? The plant is priced at Whitmark 5.4 million, and this amount is payable when the plant is delivered to Menwith Co. Right, payable when the plant is delivered. Right? The delivery has been fixed for 1st of August. 12th of May is the contract date. 1st of August is the delivery date. So there is time frame, May, June, July. So there is about 2.5 months period. So you never know what will happen during that period, whether it's going to go up or down. Now that risk is there, right? If the exchange rate fluctuates or foreign currency fluctuation is unfavorable, Menwith will have to pay more, right? And if the currency fluctuation is favorable, they'll have to pay less, right? It can work both the ways. Yeah. Now here it's the fair value, right? The asset, right? The assets value, major new item of processing plant. The processing plant is a PPE, right? So PPE's asset value also will be fluctuating while the payment also will be different, right? So what are the two items here? Fair value, right? When the asset is being recognized at a different functional currency, right? Not functional, presentation currency, right? So Whitmark translated into the dollar, which is the presentation currency. Yeah. Yeah. So in that case, there are risks from two sides. One, the fair value of asset understatement or overstatement, right? It's going to be different, right? On delivery date, the asset value will be different. So the fair value calculation on the delivery date will be based on the foreign currency exchange rates on that date. Yeah. So the fair value of asset difference is one part, right? If the fair value is overstated, understated, that's going to impact the depreciation or the P&L, and it's going to also impact the ratios, right? The ratios that uses asset as a base. Yeah, right. And then the payment that is to be made. All right. So 1st of August is where it's payable. The payment that you're going to make, right? If today's rate is good, if the rate becomes unfavorable, they'll have to pay more. If the rate becomes favorable, they'll have to pay less. As I told, there is two ways, right? But that's a risk. And to avoid that risk, you can get into hedging. Now, hedging is a risk management strategy. Yeah. And in this case, as you know, the hedging is broken down into fair value, cash flow, foreign operations based. So here, since it's fair value risk based on fair value arising due to the foreign currency fluctuation, this will be a fair value hedge, right? Fair value hedge. When there is when there is a hedge, you will have to have two items: hedged item and hedging instrument, right? Eligible hedged item versus eligible hedging instrument. All right. Okay. So we have understood the rationale of hedging. Now, hedging, although is one of the complicated areas that candidates find, with the importance and how it's being recurring in the past papers, it's very important that you understand hedging as a whole because you'll see these questions more frequently. All right. Right. So, in accordance with group risk management policy, Menwith Co. has hedged the purchase by entering into a nil cost forward contract on 12th May. Right. So, based on risk management policy, hedging has been entered into on 12th May. Right. To buy Whitmark 5.4 million at a fixed rate of $1 is to 3.25. Now, when there is a forward contract, it is going to be an obliging a commitment, right? Your commitment is a lock-in rate. Whether things work favorably, you can't take that advantage. If things work unfavorably, you are anyway safe, right? So you are at risk if things work favorably. You are safe when things work unfavorably. But this is a lock-in rate, 3.25, so 3.25. Whether the rate becomes 3.15, 3.35, doesn't matter. You are still going to be, your part is going to be based on 3.25. It prepared documentation to support fair value hedge accounting prior to 12th May, right? Documentation was prepared prior to 12th May 20X1. Right. Then exchange rate information has been given. No accounting entries have been made by Menwith Co. in respect of the hedging agreement. Right. So you can speak from that context, and then you also can speak about the effectiveness criteria of hedging relationship. Hedging relationship should be effective, meet effectiveness criteria. Right. So effectiveness criteria. Right. Let me take a page. Yeah. All right. Okay. So requirement B1, discuss whether hedge is correct. This is what you're supposed to do, right? So you just speak about how do you start hedging arrangement. Is a risk management mechanism. Then you speak about hedged item, which is firm commitment, future commitment, right? Right, to purchase PPE. Now, since there is a fair value fluctuation due to currency changes, it's an eligible or qualified hedged item. Then you talk about hedging instrument. right? Which is the forward contract, right? Forward contract. Yeah. This is eligible qualified derivative, right? Qualified hedging instrument, right? You speak about that and you're applying, right? Whatever knowledge, bring that knowledge to apply it. All right. And then hedge effectiveness criteria. When will hedge become effective, right? When will hedge become effective, right? You have to identify there is fair value hedge in this context, right? When will hedge become effective, right? So there are certain criteria. Number one is designated and documented, right? Prior to the arrangement. Then you apply in this context. We go back to the exhibit, right? So hedged purchase entering into nil cost forward contract on 12th May, 12th May, right? It prepared documentation. Documentation is prepared, designated, right? On 12th May, right? Fair value hedge accounting. They support fair value hedge accounting. They're mentioning that it's fair value hedge accounting as well. Okay, right. That's done on 12th May, right? And then you also have to look at whether there is an economic relationship between hedged item and hedging instrument. Okay, knowledge part. So what are you supposed to do here? You're supposed to look at the relationship between the hedged item and hedging instrument, right? The relationship should be such that when one part gains, the other part loses. When one part loses, other part gains. That's how you're going to make it a zero risk, right? Zero risk arrangement. Yeah. If both are working in the same direction, yeah, let's say if the hedged item is having a loss or gain, and then hedging instrument is also having a gain, ineffective. Hedged item is having a loss, hedging instrument also loss, ineffective. So one item should move in one direction, the other item should move in the other direction. Only then there's economic relationship. And then you apply in this scenario, in this context, you have to apply. Now forward is fixed, right? Fixed at 3.25, 3.25, yeah, 3.25, yeah, it's fixed, 3.25. So if hedged item 3.15 becomes 3.15, right? Favorable change, but still this 3.25 is unfavorable, right? So what happens here? What happens? The forward is hedging instrument, 3.25. Hedged item, if hedged item, right? Let's say if the value is 3.15, this becoming better still keeps this worsen. If this becomes worse, this becomes better. There is an economic relationship. You can prove that there is an economic relationship as well. All right. Just looking at all of these, there are qualified hedging item, hedged item and hedging instrument qualified. Then the designation and documentation has happened. Economic relationship exists. Therefore, now you can conclude men with co is correct. That's how you discuss. You discuss from the context of the knowledge, the standard understanding. Are we clear? Yeah. Right. So that is B1. Right. But remember, when you're talking about this, you also, before you bring this conclusion, you also will have to talk about, right? You also will have to talk about how, give a small comparison, how the situation would be without hedging arrangement, if not available. You will have to apply to the scenario, right? So there is going to be higher PPE cost, right? And that would mean higher depreciation in the future, a higher depreciation in the future, right? Then that would mean lower profits. All right, so that would be the issue. Now, although hedging is a choice, it's not a compulsion, it's not mandatory. It's a choice that Menvitco can make for the risk management. Therefore, this is better. It's better to get into hedging arrangement, which is why Menvitco is correct. Right. Now let's proceed into the requirement 2 or sub requirement 2 of requirement A. Requirement B. Again, limit your answer within exhibit 2 itself. Yeah. Explain how Menvitco should account for hedging arrangement in the year ended 30th June 2021. Calculating amounts will be recognized in the financial statements. Right. Now you will have to talk about the accounting concept, right? Accounting concept here. Okay. Accounting context is what you're going to talk about, and you will have to talk about from first forward contract, which is the hedging instrument, right? Talk about how you account for it, right? Now this is a derivative, right? It's a derivative, right? Initially, you are going to recognize at fair value, right? Fair value, okay? But when you look at this situation, if you look at this situation, what does it say? By entering into a nil cost forward contract on 12th May, on the date it was gotten into, a forward agreement was arranged, or the forward contract was entered into, the cost was nil, right? It was a nil cost. Okay, therefore no initial cost. All right, since no initial cost, hence no initial accounting entry. Okay, but at the reporting date, right, at each reporting date, now this is all the knowledge from the standard reporting date, right? The derivative will be remeasured, or derivative is remeasured to fair value. Why? Derivatives are usually held at fair value, right? Fair value through profit or loss, or fair value through other comprehensive income, but mostly fair value through profit or loss, since there are certain restrictions of fair value through OCI. All right, so you have to, at each reporting date, the derivative is remeasured to fair value. Okay, and when there will be a change in fair value, right? When there will be a difference, this would give rise to a gain or loss, right? Or loss, and this will be recorded in SBL, right? Now this is necessary whether hedging arrangement is applicable or not. Okay, right? Okay, so that's the knowledge part. Now you apply. So you have to support with calculations, right? You have to support with calculation. Yeah. So on for 30th of June, X1, right? What was the contracted rate, right? What was, now here you have to do a comparison between the outcome with forward arrangement on contract date versus outcome with forward arrangement. Now you have to assume that you're getting into forward arrangement on the reporting date, right? On reporting or on settlement date. So you have to look at the difference. You have to look at the difference, right? So what was the contract date rate was $1 was WM 3.25, right? But what was the rate prevalent, right? What is the rate prevalent on the closing date? 3.15 and 3.18, right? Spot rates of 3.15 and 3.18 was the forward rate, right? The forward rate, assuming that on 12th of May you got into forward rate, the forward rate was 3.25. But if you get into forward rate on 30th of June, then it becomes 3.18. Okay, $1 is WM 3.18. Okay, so now that would change the fair values, right? Fair value. What's a fair value? What's a fair value? Right? If you take the fair value, right, in WM, it's 5.4 million, right? 5.4 million. So now you have to look at the difference between what 5.4 million would have been at 3.25 versus what 5.4 million would have been at 3.18. Okay, right? So 5.4 million divided by 3.18 versus 5.4 million divided by 3.25, right? And that would give rise to either an asset or a liability, right? Either an asset or a liability. Okay, so in this case there is a contract asset, right? So in this case it is a contract asset. Yeah, asset, right? Let's do the math quickly, although it's not the complete answer, but let's do the math quickly. All right, 5.4 divided by 3.18 is 1.698, or let's say 1.7. 5.4 divided by 3.25 is 1.66. 0.66. Yeah, 1.66. So difference between 1.7 and 1.66 is 0.04, right? 0.04 in millions. All right, so 0.04 million is the asset. Okay, right. So that is to do with the forward contract. Now, since the derivative asset is becoming debited by 0.04 million, right, credit will be the gain, right? Debit asset 0.04 million, credit gain, there's a gain, right? Gain to P&L, 0.04 million. Had it been a liability, credit the liability and debit the loss, right? So in this case, it's an asset, it's a gain. Right. Now let's talk about from the hedged item perspective. Hedged item. All right, so hedged items, which is the firm commitment. Future commitment. All right, right. So this is a fair value hedge. So you need to remember it's a fair value hedge, right? So fair value hedge. In a fair value hedge, the cumulative, the collective change in fair value of the hedged item is recognized in the financial statements. All right. Okay. So now how do you do the comparison of the fair value? The fair value will be using the spot rate, right? So you do a comparison between spot rates. Yeah, go back. Now we have a spot rates, 3.3 versus 3.15. 3.3 versus 3.15. Okay. So how do the comparison? You take the spot rate on contract date again, date versus spot rate on reporting date. This was 3.3. This was 3.15. All right. So what's the fair value of the firm commitment? It's 5.4 million. Same thing, right? So now you have to do a comparison between 5.4 million at 3.15 versus 5.4 million at 3.30. All right. And you have to look at whether there is a gain or a loss, liability or an asset. 5.4 divided by 3.15 is 1.714, right? 714. 5.4 divided by 3.3, 1.636, right? 1.714 minus 1.636, right? There is 1.714, right? 1 minute. 5.4 divided by 3.15 is 1.714, and 5.4 million divided by 3.3 is 1.636. Right. So what's the difference between 1.714 and 1.636? 1.714 minus 1.636. 0.078. 0.078. Yeah. 0.078 million. Yeah. Or you can round it off to 0.08 million as well. Yeah. Now this, in this case, it's a liability. In this case, it's a liability. Therefore, you will be recognizing it as, now corresponding is going to be on debit to P&L. So it's going to be credit liability 0.078, debit, right? So you have debit loss, right, of 0.078. But if you look at the derivative gain, there is also gain from previous, right? There is a gain here of 0.04, and here there is a loss of 0.078. All right. Now, what is the net loss? What's a net loss? Although there was a gain of 0.04, loss of 0.078 is higher than the gain of 0.04. Now, what's a net loss? Net loss is going to be total loss on hedged item and total difference between total loss and total gain on hedging instrument. 0.078, 0.04. So there is going to be a total loss, total net loss of 0.038. So that's a total net loss. All right, but these, if you do it in thousands, it's going to be different values. Since we rounded things off, it's coming to closer values. But if you do it in thousands, there's going to be slightly different values there. Okay, now this shows there is hedge ineffectiveness. Why? Anyway, there is going to be a loss, although it's a risk management strategy where Menvitco wanted to manage and safeguard themselves. Anyway, there's a net loss. There is going to be a loss. They have to take consideration, right? And both are presented under, presentation would be under IFRS 18 as per IFRS 18 rule operating section, right? So you can either show a net loss or you can show a loss on hedging, a hedged item, and a gain on hedging instrument. But usually it's a net loss that you're going to show. All right. That's how you approach this requirement. That's how you approach this requirement. All right. So that's the requirement B. But are they asking you to look at exhibit 3 and 4? But there's exhibit in 3 and 4 as well, right? That you have to look at. So that you have to look at for C. Using pre-populated spreadsheet response option with exhibits 3 and 4 and your previous answers, meaning now you have to refer to all the calculations and make the adjustment of pre-populated spreadsheet. Now let's quickly go and look at what these remaining exhibits are. The remaining 2 exhibits are. Okay. Acquisition of Swinstico. Morstone Co. acquired 80% of the ordinary shares in Swinstico on 1st January 2080, 6 months. At acquisition date, Swinstico's administrative officers were found to have a fair value of 2.5 million in excess of their carrying amount. There is 2.5 million fair value adjustment, so that gives rise to fair value adjustment. And since it is administrative officers, there is going to be post acquisition depreciation, right? Excess depreciation. All right. Right, 20 years. They've given 20 years useful life as well. Yeah, so 2.5 million divided by 20 for the 6 months is going to be the excess depreciation. During the year ended 30th June, Morstone Co. sold goods to Swinstico for 1.9 million, giving rise to an unrealized profit of 80,000. Right, so there's intra-group transaction, and there is unrealized profit, intra-group transaction. So you have to eliminate that. Intra-group sale, you eliminate that, and unrealized profit, we eliminate that as well. Right? Post-acquisition excess depreciation, you do adjustment for that also in P&L. And then both Morstone Co and Swinstico pay corporate income tax at 20%. So there is going to be a deferred tax impact, deferred tax adjustment. Right? So deferred tax adjustment also needs to be done. So as you read the exhibit, you understand, okay, these are the requirements you will have to fulfill. Right. Further information, Exhibit 4. The draft consolidated statement of profit or loss and other comprehensive income has been prepared by adding together the income, expenses, and other comprehensive income of Morstone Co., Elabol Co., Menwith Co., and Swinstico. No further adjustments have been made. However, in each case, the relevant proportion of subsidized separate profits and total comprehensive income has been allocated to the NCI. So you have to do the allocation accordingly. Right? And that's how you go and complete the pre-populated spreadsheet, the detail of which the detailed response drafting we will be looking at in the live classes. All right. Okay. Then comes question 2.